let's dive into some of the questions that we got from folks before. We actually received a few questions about this relative to the office market and all the new construction that's taking place. Bob, how do you see this playing out relative to absorption, particularly in the Hudson Yards and what's happening downtown?
Well, I think the city's in desperate need of new construction from an office perspective. If you look at Midtown, the average office building is over 50 years old. A lot of them functionally obsolete. So I think the new construction is great for the city. I think Hudson Yards will probably be the center of the city within the next 10 years. That's very, very positive for New York. We need that new office stock to be competitive with global cities. And so I think that's a very positive thing. And I also think with both the population growth that the city is anticipating and the job creation that we expect to see based upon the tax reform, a lot of that supply should be absorbed and ultimately will be. It was actually a great year for office leasing activity and absorption. So I think that those dynamics will play out very positively.
Speaking of office leasing activity, have you ever seen, this is something that you and I have talked about, have you ever seen a condition where the office leasing market is essentially on fire and the investment sales market is slowed down as it is?
It was funny. We had, last night at CNW, we had a run-through of what our annual press conference was like for the folks internally, and one of our office leasing brokers, Mike Bergio, asked that same exact question. He said, have you ever seen anything like this? And no, usually the office leasing market is pretty much in lockstep with the capital markets. It's disconnected this year, and I think it's for a couple of reasons. One, I think that a lot of the activity in the office leasing sector has been caused by the decrease in rents. Concession packages have been way up for a year and a half. And finally, we're starting to see not only those concession packages going up in terms of free rent and tenant improvements, like the number of TI installations over $100 a foot is off the charts this year. But I think that you've had landlords that are getting very, very competitive to keep tenants. Rents are coming down, and that's what's stimulating a lot of activity. Also, all the new supply that's coming on, we have a lot of tenants that are making leasing decisions 3 and 4 years in advance of their lease expirations because they're going to new space. So that has been driving the office leasing sector. In the capital markets, it's just been the downward pressure on rents negatively impacts things. So, again, it's not playing out any differently than it has over decades in the capital markets. We're just have been going through a tough time.
We had a couple of questions specifically about interest rates. One in particular said, the short end of the yield curve is rising faster than the long end. Bob, what do you think the implications of this are for commercial real estate in the near term?
Okay, I think the issue of interest rates is really misunderstood by a lot of folks in the real estate market. The general perception is that if rates rise, it's a bad thing. And I've always said rates rising is not necessarily a bad thing. It's always why rates rise, right? If rates are rising because the economy is stumbling and we can't sell bonds and there are fundamental problems, then rising interest rates are horrible because net operating income in buildings is going to go down. And if interest rates go up, and cap rates are highly correlated to interest rates, cap rates go up, you're going to have a significant diminution in value. However, if interest rates are going up because there's real traction in the economy and we're getting 3%, 3.5% GDP growth, that's not a bad thing. It's actually a good thing. It's a bad thing that rates have been so low for so long. Rates being so low for so long is emblematic of financial policies that are not working, all right? And there's no doubt about that. We've had an administration prior to the current one that was basically stepping on the oxygen supply of business, and that led to low growth and low rates for a very long time. So the dynamic between the short end and the long term of the curve, I think the 10-year is going to open at, 263 this morning. The 5-year, I think, is at 245. So there's a narrowing gap between the short end and the long term of the curve, that's happening for a couple of reasons. One is that short rates have been bumping up at a much faster rate than long rates have, and that normally is problematic. Every time the yield curve inverts, and the inversion means that short rates are a little higher than long rates, that is highly predictive of a recession. In fact, when the yield curve has inverted, it's accurately predicted 13 of the last 14 recessions that we've had. So that's problematic. The good thing is that I think the government can control the long end of the curve by selling some of the bonds they have. But I think the incentive across the board is not to have rates get too high. But I think that the increase in rates will be moderate. They'll be telegraphed so that they're already built into the market. There won't be any surprises. I certainly would not expect any 50 basis point increase in rates. They're probably very modest at a quarter of a point each when they kick in. But provided there's good traction in the economy, not necessarily a bad thing.
Just switching topics a bit, one of the questions was, how do you think the current administration is doing on the affordable housing front and their initiatives that they've taken on?
Okay, I assume that means the local mayoral administration. Look, affordable housing is a huge issue. I always talk about this. We need affordable housing. We need workforce housing. We need to have places for people to live that are affordable, people who basically run the city, police, firemen, teachers, people who work in bakeries and auto mechanics and stuff like that. They need a place to live, and they're being priced out. So, I think that the numbers that the administration has put forth in terms of how they're doing with the creation, or their favorite word, preservation of affordable housing, are way overstated. I mean, if HPD makes a loan on a 100-unit apartment building, they claim that they preserved 100 units because they made a loan on it, like no other bank is going to make a loan on that property. I mean, it's absolutely ridiculous. I think the problem is that we have the new Affordable New York program, which replaced the old 421A. Certainly that's a positive thing, but yet I don't think the incentives provided in that program are going to create anywhere near the amount of affordable housing that we need. So I say every politician I meet with, I tell them, look, all you have to do is create the right incentive packages. That private sector is like a ferocious lion. They'll do anything you want if you give them the right incentives and motivation to do it. You want 200,000 units of affordable housing? You want 500,000 units of affordable housing? Create the right incentives and you'll get it, but they just can't seem to get on board with coming up with the right incentive packages.
Another question we received was, Bob, I've seen many New York buyers are starting to buy properties outside of New York City. Where is the current demand coming from then in the market if buyers are leaving the market?
Where's Mitch Rutter? We just had this conversation up, outside 10 minutes ago. There are a lot of people who had only bought property in New York City for decades that are now looking outside New York, simply because the yields are still very, very low. The yields are more compelling outside New York. And it's just very, very challenging. We have a lot of folks who are buying property in New York, particularly in Manhattan now, that are long-term holders. They're family buyers. They're looking for preservation of capital rather than return. And if you're an investor looking for a return or have or know what an IRR is, you can't compete with somebody that says, I'm buying this property for my grandchildren. And Terry, you're laughing, but I'd say 60% of the folks that we sell property to don't know what an IRR is, nor do they, they don't want to know. They just want to know, hey, I'm buying in a good location, I'm going to hold this building, my kids and my grandkids are going to be happy I bought it, and as long as you don't over-lever it, you know what, you'll be thrilled that, those kids will be happy that Grandpa bought the building for them.